Hello guys, today we'll look at the moving average indicator. My name is Janis, my job is to grow your wealth. In a fast-pacing market, the moving average can help you filter out the noise from random price movements and smooth it out in order to see the average value. Moving averages are used to identify trends and confirm reversals. When the price is above the moving average line, we consider the instrument to be in an uptrend. If the price is below the moving average line, we consider it to be on a downtrend. The breaking of the moving average line usually implies a trend reversal. Now let's go more practical and watch it on a chart. I'm using TradingView for analyzing of the charts. I could also use Thinkorswim in the future. If you are more familiar with it, let me know in the comments. Thank you. Let's look at Tesla for an example. I found two really good examples for an up and a downtrend. First, let's look at an upwards trend. This red line here is the moving average, and you can see as soon as it crossed the moving average upwards, above the moving average, you can see it goes from 374 up to $461. So a clear upwards trend. We can check it for a downward trend. Here you can see as soon as it crossed below the moving average, the red line is the moving average, as soon as it crossed below the moving average, it goes from 449 down to 441. So you can see you can use the moving average for an upwards trend and a downwards trend. You can see what is the price doing. The moving average can be used to identify areas of support and resistance. Many traders out there will consider the moving average line as a support and resistance level indicator and base their trades on it. You can use it to see whether the price is going towards the moving average and see if it will bounce back from it or break it, as with regular support and resistance levels. Many times the price of an instrument will find support at the moving average line when the trend is upwards, and will find resistance at the moving average line when the trend is down. So now let's get more practical and watch it on a chart. I'm using TradingView. I could also use another platform in the near future. If you're more familiar with it, let me know in the comments. Thanks. Let's look at the charts now. I found two good examples for resistance and support. First, let's look at support. I'm currently watching Apple stock, as you can see, and the red line is the moving average line, the exponential moving average line to be more specific, but we will talk about that in another video more in detail. So, as you can see here, it tried to pull back, the price tried to pull back, but it bounced off the moving average line. So in this case, the moving average line clearly functions as a support for the price. So next, let's look for resistance. You can see it tried to go above the moving average line, which is the red line here, but it clearly got rejected, and the moving average functions as a resistance here. Moving average will tell you whether an instrument is trending up, down, or if it's ranging. So moving average can tell you if a trend is still in motion and whether it is reversing or losing momentum. But always have in mind that the moving average is based on past prices and is known as a lagging indicator. Therefore, it will not warn you in advance, but it will confirm when a trend change has taken place. What do I mean by past prices and lagging indicator? Let's look at a chart to show you what I mean. I'm using TradingView, but I could use another platform in the near future if you're more familiar with it. Let me know in the comments. So let's look at a stock to show you what I mean. So let's look at Apple stock. What do I mean by past prices and lagging indicator? You can see the moving average is the red line. So if I check this point here, it's saying $113.95. But this is not the actual price. This is actually the cumulated price of the last 15 pips. I'm using EMA 15. So it shows me at this point right here the last 15 pips. So if I take the last 15 pips, I would get this price here, 113.95. That is what I mean with past prices and lagging indicator. You should never use this as a live indicator just to know if the stock is trending upwards or downwards, just for you to confirm the trend. Today we'll look at how the moving average can be used to define when to buy and when to sell. So let's look at it at the most basic level. When the price crosses up and over the moving average, many traders take this as a signal to buy. When it crosses down under the moving average line, they consider it a signal to sell. So you see, you can use it either to identify to buy or to sell a stock. So now let's look at the chart to show you what I mean. Today I'm using TradingView to look at the charts. Let me know if you would prefer Thinkorswim for coming future videos. Let me know in the comments. So let's look at Tesla stock to show you what I mean. I found two perfect examples for a signal to sell and a signal to buy. First, let's look at the signal to sell. As you can see, the red line is the moving average, and here it crossed down below the moving average and the price dropped. So this would be a perfect sign to sell your stock, a perfect sign to buy the stock. Here we have a perfect sign to buy the stock. You can see the red line is the moving average, and as it moves above the red moving average line, this is the perfect signal to buy. As you can see, the stock price increased right after it. So you can see you can use the moving average to know when to sell and when to buy. Today we will look at the different types of moving averages. There are three main types: the simple moving average, the weighted moving average, and the exponential moving average. First, let's look at the simple moving average, or SMA short. I will show you how it's calculated so that you can adjust it according to the given market circumstance. So for example, if you want to plot a 15-day simple moving average, you would add the closing prices of the last 15 days and divide it by 15. This calculation gives equal weight to each day. It is called the moving average as the oldest price is dropped each time a new period becomes available. This way ensures that the average is based only on the last number of periods, in this example for the last 15 days. Always have in mind that the longer the simple moving average period, the more it lags, and the slower it is to react to the most recent price movement. So let's look at the downside of SMA next. Because equal weight is given to all periods, the simple moving average is slower to respond to rapid price changes that might prove to be important. So, is there a way to counter this downside? Well, yes, there is. With another type of moving average, you can counter this. Either a weighted or an exponential moving average. Today we will look at the weighted and the exponential moving average. The weighted and the exponential moving averages are calculated differently from one another, but both types give more weight to recent periods and thus more emphasis on what traders are doing at the moment. So as a result, weighted and exponential moving averages respond faster to price action by distributing more weight to recent periods and less to older periods. They reflect a quicker shift in sentiment, which can be due to changes in supply and demand or important news events that impact the traded instrument. Illustrate what I mean. If you were to plot an exponential moving average and a simple moving average on a chart, you will see that the exponential moving average is closer to the current price than the simple moving average. Today we look at when to choose which type of moving averages and the typical time frames. Apart from the type of the moving average, you also have to decide on the time period. This will largely depend on the type of trend you are analyzing. Here are some guidelines for commonly used time periods. 10 to 20 for short-term trends, 50 for mid-term, and 200 for long-term trends are typically used. So, when and how should you use moving averages? Deciding which moving average to use and the time period will depend largely on your objective. Use exponential moving averages for shorter time frames, or if you are analyzing a fast moving market, as you would have more emphasis on the latest prices. Use the simple moving average if you are planning on holding a position for a longer period of time, as the exponential moving average might be too sensitive and give false signals. You should also use the simple moving average if you just like to filter out the noise and random price fluctuations to determine the overall market direction. If you watched the video till this point, please make sure to smash the like button. Also, please consider subscribing and hit the bell to get notified about any future video. If you liked what I showed you today, check out this video here next. Trust me, this is the perfect video for you right now. Just click it. If you want to stay connected on a more regular basis, make sure to follow me on Instagram. I post there more regularly than on YouTube. Thanks again for watching. I hope to see you in the next video. Take care. Bye.